Welcome back, everyone, to Vox Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to stock analyst and markets commentator Paul Scott to discuss all things small cap. So welcome, Paul.
Hello, Paul. Hello, everyone. Good to be back.
Yeah, whether like the music, we're really rocking on the market today. Masses of news over the last 2 days. So maybe we can start on the M&A front. We've had one company, very popular with investors, industrial chains manufacturer Renold, apparently receiving 2 preliminary bids. Could you just say a few words about that one and what it sort of like says about the UK market? Any read across to other sort of like similar industrial companies, which we've got quite a few to run through today?
Yeah, well, this has been a share we've been positive on my Substack and prior to that on Stockopedia. Now, for years, we've been permanently green on it. I remember presenting this one at Mello Online, and it was 14p. And it's now 5 bags from that level. Of course, I got bored along the way and sold mine. Always the way. But I think what's interesting is that we're now starting to see bids for these smaller value type shares. Because last week, I think we were talking about H&T, and a similar thing this week for Renold, which are not the type of shares you would really expect bids for. You know, normally it's medical instruments, software, IT on very high multiples. That seems to be the growth companies attracting bids. So it's very interesting, I think, now that more value type companies are attracting bids. So yeah, as I say, Renold was hiding in plain sight in terms of the value in the shares. It does have a very substantial pension deficit, which so it's interesting to see somebody bidding for something with a deficit, because there is an argument that a bidder could have a stronger covenant than Renold itself, and that could help bring down the deficit in the actuarial calculations as a sort of spin-off benefit for the buyer. So no, I think it's fabulous news, and it just reinforces how cheap the UK still is, although obviously we've had a fantastic rally along with all other markets. But
just technically then, how does the group covenant affect the actual pension deficit? I always thought it was done on sort of like double A corporate bond yields was the actuarial.
I'm not sure, but a friend of mine, we co-analyze shares, and he's very good on pension funds, and he said that was a potential, because I said, oh, no, nobody's going to bid for a company with a big pension scheme, and he said, actually, no, there is this angle on it. So I'm only really repeating what I've been told.
Yeah, okay. Now I've got a tough question for you, Paul, because whenever we talk about M&A, you say you adopt this sort of like policy whereby let's sell half in the market.
Sometimes,
well, we never say never, so that's why we're giving you an open door here. What in this instance, you've got 2 bidders at a higher price. Independently, what would you typically do here?
Oh, it's so tricky, isn't it? I mean, you have to look into all the detail of it. And so number one question is how credible are the bidders? And I think in this case, I can't remember off the top of my head, but I think were they named the bidders?
Yes, they were. They were credible bidders. Yeah, they were credible bidders. One was private equity, and then one was a trade bidder, but funded by private equity.
Yeah, so if the bids in that, as in this case, sound credible and they've named the potential prices, then the obvious conclusion is, could there be a bidding war? And I remember, what was that equipment hire thing a few years ago, where there was a whole series of 2 or 3 groups all wanted it, and the end price was a fantastic outcome. So you could have that with Renold, I think, but equally you've got to balance that up with, well, what if it falls through, given that macro is tough and all the rest of it, or if they find something in due diligence, which of course happened recently with Warehouse REIT. That bid has gone a bit wobbly because some disagreements were found over valuations during the due diligence. So I suppose each investor just has to weigh up risk and reward, don't they? On each situation is unique, but I think you can never go wrong selling half. I think.
Okay, I thought for a moment you were going to duck the question there, but no, good man. No, I must admit I would take a slightly opposite. With 2 credible bidders, I would let this one run. But personally, if I owned it, I mean, that's no advice from me and Paul. It was just saying that if we were lucky and fortunate to be in a position of having 2 bidders, what we would do. But let's go to some other sort of value plays, industrials. Let's start with a really well known, not really, Let's go for a domestic steel radiator manufacturer, Stelrad.
Oh, yes,
They came out
Stelrad.
This week, very, very cheap. I was just looking at the actual numbers. 9.4 times PE on trough earnings, given that the RI and home domestic sort of like build market is in a poor state. What was your sort of like your take on Stelrad?
Well, we like this one. We've covered it before. We've covered it 3 times this year, and we've been green on our traffic light system each of the 3 times. So we like it. I think you've hit the nail on the head, Paul. It's hopefully bottom, trough earnings. And then with this type of thing, if you're only paying a PE of 9 or something on trough earnings, then you're getting the upside in for free. And I think that's really interesting. So my colleague Dave wrote a section on this yesterday. It was the AGM trading update, which was in line despite a challenging market. So that's quite encouraging. I'm finding generally, I think most broker forecasts now seem to be quite conservatively set. So we're finding nearly everything that reports is reporting in line at the moment, which is good. It says their supply arrangements are stable at Stelrad. Margins and cost management are helping profits, they say. And the broker forecasts were unchanged for calendar 2025. Tariff risk, it said, is low. And we got an interesting angle on the balance sheet here. Although it's got 67 million net debt, which is okay-ish. It's 1.6 times EBITDA. But, oh, no, maybe I've got the wrong company. I thought this one had... Yes, here we are. Half of the debt is backed by freehold property assets. So I think you could kind of adjust the debt, offset the freeholds against it. So when you look at it in that perspective, the debt is actually quite moderate. So yeah, we think a thumbs up from us. We think no advice intended, obviously, and we don't own any personally. So we're not talking our own book, but we think Stelrad looks good.
Yeah, no, it definitely looks cheap. A whole bunch of industrial and sort of like building products companies. Look, if there's an M&A theme, then these guys could get mopped up. We've got anybody wants to ask Paul any questions, please put them into the chat box. We've got one from another very value sort of based stock from Letije09. He's asking about Future Group, which is basically this price comparison website, Go Compare, plus a lot of sort of like websites, first party data that it sells advertising on. And I guess the sort of key question is how impact this is going to be from AI, and whether it's a value trap or a value play at these current depressed levels.
Yeah, well, funnily enough, I had an excellent lunch yesterday with some real AI experts, and they said to me, actually, audiences will be the valuable thing in future. Sorry, not relating to the company called Future.
No, we got that.
Yeah, which quite surprised me. They said sort of paywalled content is good, but actually having an audience that you can broadcast to apparently is going to go up in value. Well, that seems to me to play right into the hands of Future, FUTR. But look, I'm no expert on that, so I'll happily be told that I'm wrong. But we did look at this one. The H1 results to March 25 were out on the 16th of May. That's last week, isn't it? I think Friday, maybe. 876 million market cap. Now, it dropped 7% on these results, even though adjusted EPS was up slightly, 4%. There's a new CEO. I don't know if they're any good or not. And the problem is, the reason why Future shares are so cheap, it's on a PE of less than 6.
Yeah, 5.1 I've got going forward.
Wowee! I mean, this is. I really need to buy some of these. I think this is so cheap, and it's an absolute cash cow. It produces all this cash, and people seem to be almost writing it off as something that's in decline. So I think the key thing is they need to start to generate revenue, top line growth. I think the market is saying, oh, it's X growth, it maybe is even declining now. That's the problem. The balance sheet is weak, it's negative, but it doesn't actually matter because it's a capital light business and the debt is only 1.1 times EBITDA. So yeah, I really like Future. I think it's very good value. But over to you, Paul.
Yeah, this is one of the few actually. We have totally opposing views. I would say this is a value trap, and the reason why I say that is that we've got a now fundamental shift in AI with internet discovery away from internet search. And you had yesterday Google announcing that it was going to take its blue links off its search facility, because it was basically then just going to reference it, and so it will give answers all the time. And likewise, I use ChatGPT and Grok, and they just give answers, and they do have sources where it's come from, but they're not click-through blue links. So if you are a digital publisher advertising, which you sell ads on your website, if you've got a big proportion of your traffic that comes through clicks from people searching, you will not get as many, because people don't need to get those links and go through it in searches they've done before. So I actually think these first party data models, unless you've got something unique that is going to basically protect you against the generative AI discovery engines where they just put answers, I think you're going to really struggle. So I would say, I just don't. I would personally steer well clear. So it's interesting how two experienced investors of 30-year careers have totally different views on it. But I would say the valuation is very cheap.
It's so appealing, isn't it? Yeah, I mean, this share used to be a real growth share on a very high PE. It was worth billions a few years ago, and now it's valued like a newspaper group in decline or something. So, I mean, I don't think it's something I'd want to own forever, but I think certainly as a swing trade, for maybe 6 months. I tend to do quite a lot of those. We were talking about it at the weekend, weren't we? I've got, personally, I use two approaches. I've got my long-term buy and hold stuff that's just in my SIP, and I forget about them basically once they're in there. And then I do some swing trading as well for 3 to 6 or 9 month, sort of catching a move up, hopefully, and then moving on. So future would be in that category for me personally. But no, very interesting points, Paul. And I know nothing about AI. It just continually dumbfounds me. I mean, the trouble is, it's not actually intelligence, is it?
No, it isn't. What it is, it's very good at bringing information together and providing an answer quickly. Assimilating from it. By the way, I have to apologise because I don't quite remember when you're saying with the swing trading at the weekend, because you drank me under the table, Paul. I was just absolutely
we had a bit of a session, didn't we? But,
Okay, right. Let's move on. We've got Dan. He's basically asking about Bloomsbury that came out with results or a trading update. His big question is it's a publishing business. It's got J.K. Rowling and Sarah J. Maas on it, and it also bought a academic stroke non-consumer facing publishing arm last year in the States. His key question is it going to continue? Is it going to grow? Because he's a bit worried in terms of, again, sort of the technology and just sort of like getting more key authors on board.
Yeah, well, funnily enough, we looked at this morning. My colleague Dave did a section on this for my Substack. We think it looks really interesting. I mean, we couldn't really see why it's dropped today. So maybe the readers can put something into the chat bot. I mean, the actual results that came out this morning were for February 2025 year end, and they were slightly ahead of forecast. But the profit number was down a little bit on last year, as expected. So as an actual earnings beat, a slight earnings beat, the balance sheet is still very good. I had a look at that myself, and even though they spent a lot, 60 odd million, I think, on a big acquisition of a was it scientific publishing or something like that?
Yeah, in the States, yeah.
Yeah, and I think a lot of people are kind of scratching their heads over that acquisition, is thinking, well, it's an awful lot to spend on something that didn't particularly look a great deal. But I think the thing is, the people running Bloomsbury are super experienced, aren't they? I think it still might be even the founder still managing it. So
yes, it is. They
know what they're doing, and they've got a brilliant track record. So I did actually dip my toe in with, just for full disclosure, I bought a tiny dip my toe in long position on this morning after the 17% drop, because I couldn't see what justified that. I think they said there was some weakness in some markets, and The only other thing is they said the new financial year is only going to be broadly in line, which we all know means slightly below, doesn't it?
Yeah.
But the PE currently is about 13, and that is probably, that I think is based on a year where there were not any new releases from Sarah J. Maas. So there could be upside on the earnings figure. So we certainly don't regard this as being broken in any way. So we don't really know why the shares dropped so much today. Have you got any ideas, Paul?
I think I read somewhere that its academic publishing business, to university students, etc.
Oh, yes, you're right.
Had softened off noticeably. And if you turn your mind back to Chegg's results in the States about 18 months ago, their share price halved in a day because this whole fear of whether, yes, because of generative AI, whether you're going to need to have subscriptions for academic publishing, and particularly for students, for education. So it might be something just to do with that sort of fear that, is that part of the business going to see, sort of like pressure going forward as more people realize they don't need actually to, specialist help in certain set subjects they can just get. Because I mean, just as a sort of like a user of if you want to things do like, I don't know, genetics or DNA or anything really deep dive into it, it's pretty good. But it isn't 100% accurate. Is probably the fair reflection. But it might affect it at the margin. But I think that's the only take I would have.
Yeah, no, that's very interesting, Paul. So do you think this thing Bloomsbury will just derate then down to a PE of 6 or 7 or something? I mean,
well, I think they probably just need to sign some more big authors, if I'm perfectly honest. They need to get another stable. If they get another one to like Sarah J. Maas on top of sort of the J.K. Rowling, very difficult to find. But I think, as you rightly say, if you'd have backed the founder CEO Nigel Newton over the last 25 years, you'd have done very, very well. And so he's he's very sharp and got a great eye for great authors. He needs to sprinkle that magic again, I think, probably.
No, that's right. But no, this valuation, I think it did get a bit ahead of itself. A year or two ago, I think it became a very crowded trade, Bloomsbury publishing it. Everyone in my network, of private investors, everyone seemed to love it. And the PE got up to nearly 20 times. And you thought, this is getting a bit warm. But it's difficult, isn't it? Do you pay up for quality or do you hold back and wait for something to go wrong? I don't know. It's tricky.
I know. Okay, let's move sector. We've got another value share. She's asking about Restore, which is quite a popular one with the Harwood stable. I think Richard Stavel is in there. It basically does archiving services to corporates, whether it's paper-based or also destroying sort of their technology, their IT systems safely, etc., and also does office relocations. Had a new CEO, or the old CEO left and then came back to turn the business around. It trades at roughly around about 12.2 times PE. And I guess the key question is, can he get the top line growing, and also is it a potential acquisition target?
Yeah, interesting. Yeah, that rings a bell. The guy returning. I think somebody took over at Restore, didn't they? And they did a series of acquisitions that didn't really seem to work. And then this guy was parachuted back in to sort it out. Is he a major shareholder as well, Paul? Do you know?
Yeah, I presume so. I mean, he was the founder, so he must have a whole bunch of shares, I guess.
Yeah, I mean, I think we were quite mixed on this one. I think we thought some of the readers were commenting on it, saying, don't bet against this guy. He knows what he's doing. So I think he's got a good reputation. The only thing I would point out is the balance sheet's quite weak, not dangerously weak, but it does have 89 million of net debt, which is about, what's that? That's just over a quarter of the market cap. It's 1.6 times EBITDA. So not dangerously high, but I think you do have to add on a bit, bump a bit onto the PE ratio when a company's highly indebted. It said it was in line. This was a trading update on the 13th of May, so quite recent, about just over a week ago. Confident of achieving full year expectations. So yeah, it looks as if it's on the mend, doesn't it? I think is our sort of helicopter view of it.
Yeah, I think the CEO seems to be doing a very good job. The key is whether he can get that growth in a quite. It's a bit of a sort of oligopoly. I think it sort of like shares the market with Iron Mountain, which does other sort of like the same sort of document archiving services, which are great recurring revenue streams. But because obviously paper stuff is declining, where's it going to get growth? And I guess what you need to do is to add more services into the same customer base.
Yes, but you're right. It does have quite attractive recurring revenues, doesn't it? They buy up old salt mines and nuclear shelters, don't they? And just fill them with documents that have got to be kept for 6 years or whatever by lawyers and accountants. So it's a nice recurring revenue business. But as you say, it's going to have to bolt on other things, and they're just going to have to make sure the acquisitions are better, aren't they, going forward?
Yeah.
So quite interesting overall. Quite interesting. Yeah.
Okay, let's move to sort of like a specialist buy and build engineer. Only just listed actually, just recently. Amcomri in IPO'd in December at 55p.
Ticker on
the ticker is AMCO.
Yeah.
And it's basically made an acquisition since it IPO'd. It seems to be growing quite a lot, not so much obviously more on the acquisitive side, but the idea is that you get poorly performing, highly regulated industry engineers, you bring them all together, you improve the performance, and then you build and get a better service. And that's the sort of like they've had a successful formula doing that buy and build. Trades at roughly around 12.5 times PE, but at the moment that's obviously subscale. So how do you see this one at all? Have you any quick thoughts on it?
Yeah, we quite like it. I've looked at it twice, including quite recently. The key thing with this one to look at is obviously the AIM admission. I'm assuming, it's definitely AIM, isn't it? The admission document gives the background of the directors, and they are very experienced M&A guys who seem to know what they're doing, and that's key. I think the last thing you want is people doing a buy and build who haven't got a clue. But these guys, I think, are good backable people. About 44 million market cap. We looked at it most recently on the 20th of May, just over a week ago. Calendar 2024 results came out. It's profitable already, 1.7 million PBT. I did notice though that the finance costs were very high. That's obviously taken into account in that. So there's quite a gap between operating profit and PBT. They said the current year has started well and in line with expectations. It's got a modest balance sheet. So I think to do any significant additional acquisitions, it will probably have to raise a bit of equity. So you might have some dilution. But I think it's quite interesting. Yeah, it's worth people having a look at this.
Yeah, no, you're right. I think the experience of the CEO and the FD, they met each other actually at Hilco. Basically the private industrial. Yeah. So they have a good track record. I think that's essential. You're exactly right there.
Yeah.
Okay, good. We've got Ben Sharman. He's asking about a company that did a Q1 trading update today, which I own. Is called Water Intelligence. I don't know whether you had a look at this one. It was in line, but they did see a huge jump in sales growth in April compared to March, and compared to the first 3 months. And the rationale was because they signed this big deal with Chubb Insurance out into the States to do a full line preventative maintenance solution across the US, and also they've basically brought all these sort of like the services and new sort of AI on board as well, or new technical support, etc. And I think they had a top line growth of 4% in the first 3 months, but in April they had 20%. I haven't quite got to the bottom of it, which obviously was now boosted margin. And I guess the key question is whether it's sustainable going forward. I don't know whether you've ever managed to have a quick look at this one.
Yeah, we followed this for years. It got very, very expensive back during the pandemic, and we couldn't really understand why it was on such a high rating. But it's now, lost about 3/4 of its peak value, and we think it's actually good value now, worth a look. It's down 8% today, I believe. So, do you know why the market didn't like this update?
I think it was just the PBT. The PBT went down. They haven't explained why. But the EBITDA went up and the sales went up. And I think they looked at it more on the Q1 rather than actually at the year to date or the April. It was sort of like a classic glasses half empty, stroke glasses half full sort of perspective. But
and we noticed it's exploring a US listing. apparently.
Yes, that's correct. Yeah.
It seems very small. It's only 62 million market cap. I'm not sure that would register on the dial on the US market. Net debt to EBITDA is 1.7 times, so a little bit high on the debt side for my personal taste. But I think basically it's quite an interesting little company, isn't it? D'Souza, isn't it, who runs it?
That's it, Patrick D'Souza. Yeah. It's at 10.1 times PE, less than 6 times EBITDA. And it all comes down to basically the growth. If they become the sort of the de facto standard for all things sort of water conservation, leak prevention out in the States and in the UK, then they've got a great sort of like growth ahead. And I actually do think to a certain extent the big boys, which these guys are the biggest dog in the US, the big boys will grow faster than the rest of the market because the insurers will migrate towards them like Chubb.
Yeah, they fix leaking swimming pools and things, don't they? And I think it's the vast majority of the businesses in America, I believe. But I think this is quite an interesting one for the viewers to research for themselves. Yeah, I think it's good.
Okay, let's look at a company game we don't view much is Essentra. It basically does plastic molding for the industrials, injection molding. Is ESNT.
Got it. This one we reported on yesterday, I think. Yeah, we covered it yesterday.
And it seems to be on the cusp of a recovery. But how do you? It's a bit GDP dependent, but at the moment it's trough earnings.
Yeah, I mean the share price chart on Essentra is absolutely awful. It's just a ski slope, and you look at the chart and you think, blimey, maybe this is a recovery situation. We think it's got potential. Again, Dave wrote about this yesterday in my Substack. We think it's a potential cyclical recovery share. I have a feeling this is the one where the gross margin is 70%. If we've got that right, I mean that is so that means you've got tremendous operational gearing, well, both up and down. So I think it's one we're going to keep on our watch list to see, if you can see early stages of a turnaround kicking in. It said the order book has improved. This was in yesterday's AGM trading update. That was it. Mixed recovery across regions, it said. Expectations unchanged for the current year. I think it was on a PE of about 14, so not particularly cheap. And it's got some debt, 68 million debt, 1.3 times EBITDA. So we think this is one to keep on an eye on for signs of a tangible turnaround, which it hasn't really shown as yet. Is it one you know well, Paul?
Well, it doesn't want to know that well, but I did actually read when it comes to sort of like the tariffs, it could well be a beneficiary because it has local production in the US, and it's already getting approaches from other, it's basically some of its customers and its competitors' customers to manufacture products in the US and so avoid the tariffs. I think this one could actually, you could wake up one day and find out it does a Renold easily. The private equity take this out. It looks just like wrong price to me. I mean, I'm not on trough earnings, on difficult with higher interest rates. Interest rates come down, GDP starts to increase. It's in a nice position with the States. You can just go, you can just add on, and then of course, you'll get a lot of operational gearing and economies of scale. So, on this theme of lots of industrial value shares look cheap on trough earnings, I would add this one to the list. I don't own it, but it looks crazily cheap.
Well, I don't know about that. I mean, 14 times doesn't stand out to me as particularly cheap, but as you say, it could end up being very cheap if earnings double or something over the next year or two. I love that point you made about tariffs. One of the things, we're scrutinizing everything that pretty much all the companies on the market we follow now and report on, and we like the ones where they use phrases like, we have local manufacturing for local markets. Yes, that's the type of thing, isn't it, to look for? And as you say, if they've got manufacturing facilities in the US, that's ideal because they could start replacing supply chains from the Far East. So very interesting. Yeah.
Okay, good. We've got Mark. He's asking about Tops Tiles in the sort of like the building products. It does everything for tiles for kitchens and for bathrooms and stuff like this. He says, have the shares sort of like bottomed, and is it the sort of turning point? I know we talked quite a bit about building products last week, but quick thoughts on Top Tiles.
Yeah, we had an update from this one on the 20th of May, which was it was actually the interim results. Profit was basically flat, up 3%, but in tiny amount. The balance sheet's okay. Now, interestingly enough, I think there's some early green shoot signs here, possibly. It said it had a strong start to H2, so that would be April and May to date, wouldn't it? So strong start, and potential tariff supply chain risk, they're saying. Well, that's strange because it's UK only, isn't it? But no, we think this is worth a look, actually. You've got a 7% yield. It's good value. It's got net cash as well. Quite a light balance sheet, but it does have a bit of net cash. Yeah, I think you if and when the tiles and floorings markets start to improve, which they've been in the doldrums now for about 2 or 3 years, haven't they? I think Topps Tiles would be one of my something I'd be quite happy to have a little punt on. So yeah, I think Top Tiles. The readers are coming up with some excellent ideas today, aren't they?
Yeah, well, they did last week as well. Okay, good. Let's switch sectors. Let's go to oil and gas. We had a question from Silheti Money. He's basically asking about Harbour Energy, which we don't ever look at. It's quite a big business, $3.8 billion. It's one of the producers in the North Sea and also abroad in sort of Vietnam and places. I guess the sort of key question for sort of oil and gas really comes down to sort of the commodity and how you see that going forward, given we've got obviously Trump going drill, baby, drill. We've also got potentially, more Russia oil coming. If they ever get a ceasefire, get more Russia oil coming in, and obviously OPEC supplying it. How do you see sort of the oil and gas sector as a whole, particularly in terms of we get a surplus of supply and a reduced level of demand?
No, I don't cover it at all, Paul. So I don't see anything.
Oh, okay.
I'm not going to make stuff up to try and sound clever. If I don't, it's don't know from me on that one. Sorry.
All I would say, Salati, is that have a look at the estimates going forward, because what happens with a lot of the, let me put the chart up. What happens with a lot of the oil and gas producers at the moment is that they hedge forward the sales of their production, and therefore they can get higher prices, and that's running off because it goes for like 6 to 9 months. And then you then see 12 months or 24 months in advance, their estimates then start decreasing. So at the moment, they look, the oil and gas sector, if you look at Shell and BP, they look very cheap on a PE basis. But if you pushed it forward 2 years at existing prices, the hedges rolled off.
I see what you mean. Yeah.
Then actually they'd start to look pretty expensive. So it isn't as, you have to look at the through cycle level of PE, the normalized level, with the oil price fluctuating up and down from about 60 at one time to potentially 90, and see where they on average would come to, and how much sort of like resources growth. But I would say with oil and gas at the moment, there's probably a headwind given what seems to be happening in the geopolitics, I think. Okay. All right. Let's look at. Let's go to another one. We've got Velocity Composites, which again we don't look at a great deal. It basically does composites for aerospace, and particularly for aerospace, his big customers are BAE. We've got Airbus, I think, as well, Boeing, GKN. But I think it's got quite a lot of customer concentration. About 4 customers account for about 80 or 90% of the business. So you have to get over that. And it's a specialist in helping these large OEMs manufacture and put in composite, lightweight, strong material into their planes, which is a real skill. They provide the kits which go in there. They won a big contract, or they renewed it, I think, with BAE in the defence sector.
That's right.
Just recently. But they came out with results which I don't think particularly impressed. How do you see the sort of the ups and downs on this one?
We think it's very small, 15 million market cap. We think it's quite interesting for people who are prepared to look a bit more at the speculative side of things. As you correctly say, it renewed a 3-year contract with BAE. And, it's clearly very good at what it does. And I would imagine there are considerable barriers to entry to get certified with these major aviation groups. So quite interesting. Balance sheet is a little bit weak. It's only got 700 grand net cash. So I think it might need a top up placing at some stage. And it's a good story. They've got decent, reasonable revenues, but the one slight problem, they don't actually make any money.
Okay, whoops.
Yeah, so we think it's a nice story. It looks potentially interesting, but where's the profit? Where's the cash flow? So I think it needs to. The numbers are improving. I think the October 24 result was a greatly reduced operating loss down to 0.9 million, but it shouldn't. I don't particularly want to get into anything loss making unless it's got kind of exponential growth in the pipeline. So, but certainly, I think this is what is worth people having a look at. It does look quite interesting.
Yeah, another one in the same bucket actually that's got quite a lot of customer concentration that could potentially be a sort of turnaround, been on the market for a bit, is Calnex Solutions.
Oh, yes.
It's basically a tester of telco equipment to improve the sort of speed and performance of it. It used to supply a lot into Spirant, I think, which is being acquired at the moment.
Right. What's the
ticker? Ticker is CLX.
Yes.
CLX, yeah, and it basically it's obviously been boosted by new technologies and 5G rollouts and stuff. It makes 74% gross margins, and on good years it makes very good EBIT margins, but on bad years it's barely profitable. So, how do you sort of like look at this type of business in terms of the sort of the cyclicality to it, and also sort of like the IPR with sort of 74% gross margins?
Yeah, it's very difficult, isn't it? Like you say, the gross margins mean this thing is poised for operational gearing, and we've seen very wild swings in profitability. I think it floated sort of at a high in the cycle, didn't it? And the share really crashed. But we're sniffing around this now, wondering if it might be a possible recovery share. And I think it did. Yeah, it rose 10% on the 20th. That was Tuesday this week, wasn't it? Rose 10% on its March 2025 results, which in themselves were uninspiring. Only a very small profit, 720 grand, which is not much for a 44 million market cap company, but it did indicate early signs of improvement in the telecom sector and increasing cloud computing interest in its products as well. Confident about the outlook, got a notably strong balance sheet. Net cash is a quarter of the market cap. So we think this is interesting. Again, it's beyond my pay grade to predict what will happen in future. I don't know if it'll recover or not, but I think it's certainly worth. We've ticked all the basic boxes that it's soundly financed. It's got operational gearing. You know, it's previously been very profitable. It used to make between 6 and 7 million profits a year in 2022 and 2023. So if it gets back to that level, which is unlikely to happen in one fell swoop, isn't it? But if it gradually rises back to those level of profits, you could have a 50%, even 100% gain on your hands here. So yeah, we think it's quite interesting if you know what you're doing in terms of the sector, and I think you need to know a bit about the activities of companies in the sector, don't you? Which I don't.
Yeah, it might well be that somebody like Spirant actually buys them out, you know, in terms of goes vertically integrated, like to get an end-to-end solution for the large corporates, but large telcos and industries. But I think the key to me would be just looking at the level of recurring revenue streams. When it goes through a bad time, does the revenue really drop off, or how much visibility does it have in the difficult moments? You know.
I don't know anything about it's products rather than services, isn't it, that they do? Yeah,
I think it's both, to be perfectly honest. It's software and hardware and sort of services and performance testing and stuff like that. I think it's all wrapped into the same sort of thing. Okay, let's move to the advertising. Well, media and advertising. We've got ITV, which big business. I think you own the shares in. Obviously, it's got its linear television channel, got ITVX, which is growing significantly, and also got its studios, which I think again has done pretty well. Into the mix. It's still trading pretty cheap with a good dividend. How do you see this one going forward?
Yeah, I like it. I saw that we had the Q1 update, which is the 3 months to March 2025. That was on the 15th of May, so last week. End of last week. I thought it was all right, not madly inspiring. It said that Q1 was in line with expectations. Their trading updates at ITV are so badly written. They're full of all this disjointed detail, but they don't pull it together. So they don't give you end up reading them about twice or three times, and you're none the wiser. So vague outlook comments, I've described it as. Now the balance sheet's fine. It's got 334 million net tangible asset value. Covenant net debt is only 0.6 times EBITDA. That's fine. You've got a particularly cheap PE ratio here. It's only 9 times, and you've got a 6% dividend yield, and the pension fund is fully resolved, so no further payments into that. There's been bid interest almost continuously surrounding ITV, maybe a breakup, maybe selling one bit, merging. But there's always talk, isn't there, of deals going on. I just think on the fundamentals, it looks cheap. And I think its terrestrial TV business and its studios thing and ITVX, I think are all good quality businesses, actually. I don't see this as a business in decline at all, which I've seen some commentators seem to think, oh, it's old hat, it's rubbish, blah, blah, blah. It's not like a newspaper business, in my view. I think there's a lot of value in ITV. So, yeah, I like it, but I'm not a sector expert.
Yeah, I would say there's too many people like me who now will never go back from streaming, and we won't watch sort of terrestrial telly anymore. I even stream the BBC on the iPlayer. So,
but they make money. They make money on the streaming, though, don't they? And the advertising on ITVX is going up quite nicely.
Yes.
So it's got both strings to its bow, I think.
No, it has yet. No, I think if it was just ITV, well, basically ITVX, great, tick in the box. Studios, marvelous, tick in the box. Lots of IPR, but the linear telly, I think, makes up the lion's share of the advertising revenue still, and therefore that could be a bit of a headwind. But you're right. I mean, when you put it all into the lens of basically value and price, then it's very, very cheap, and you could easily see it being broken up.
Yeah, exactly. And I mean, I'm in it for the cheap PE and the 6% yield, and I don't see those numbers being under any threat because it's solidly financed. So yeah, again, if it was on a PE of 15 or 16, I'd pass on it. So for me, it's just a value thing. I think there's a good chance I'll be able to get out at a 30, 40, 50% profit at some point. So, and I get paid 6% to wait. So yeah, I like it.
Yeah, good. Okay, we've got a question from Vanu Kapoor. He's asking about React Group, which I think is owned by Lawrence Hulse, he says, the Onward Opportunities. And also I think Harwood owns some of it as well. It's basically, I think is it a corporate sort of cleaning business that then bought sort of like I think it was a plumbing business as well just recently to get an extra. It's quite small, but how do you see this one?
Quite interesting idea. Yes, specialist cleaning businesses, which are quite high margin, some of them, surprisingly. It's a buy and build, very small, though, only 17 million market cap. And they're in a frustrating sort of chicken and egg situation where they haven't got anything on their balance sheet. So, but their equity is so cheaply valued, they don't want to raise equity to buy stuff. So they've geared up with quite a big loan from HSBC. And I think we haven't covered it since 27th of March. I think they might be reporting next week because I got something through from an email from a PR company inviting me to some sort of presentation on it. So yeah, I think we'll maybe mention this one next week when we've got some up-to-date information, but potentially interesting, I think.
Yeah. Yeah, what's the market cap? Oh, 17 million, isn't
17, it? Very small. So we're amber on it at the moment, but I think if people wanted to have a punt on it, I wouldn't try and persuade them not to. I think it's got potential. Yeah,
good, excellent. Well, we'll see what happens at the update next week. We got Paul McBain. He's basically asking about Big Technologies. Came out with full-year results actually, which was surprising because they've got this litigation with their CEO. They also had 3 directors, the new CEO, CFO, and I think the old COO, all bought shares as well at £1.
Oh, did they? I didn't know that. That's good.
I don't know if you had a look at this at all. Big Technology.
Yeah. We've been all over this one, haven't we, Paul? We both. You took a position with spectacularly bad timing, didn't you?
Yeah. But as always.
But you're sitting pretty now because you're in profit on that position, aren't you?
Yeah, I am. Yeah, no, I am. Yeah.
You and I was out in Malta. I remember where I was when we were talking about this. Our thesis on it was absolutely right. That at sort of 60 to 80p, it was oversold. At that point, the net cash was half the market cap. So totally bulletproof and trading reasonably well. But now it's got of course I sold, didn't I, about 3 days before it shot up. I'll tell you what it was. It was during the Trump tariff crash. I just looked at my portfolio and said, right, I need to lighten up on anything I'm not 100% sure on, so that was the main reason I sold them, because I've got some gearing in my swing trading account, so you have to shut things down if the market's going wobbly. So that was the main reason I did sell. So I missed out on a very nice big rise, but we got the thesis right, and that's what it's all about. Anyway, results today. Dave again it sounds like Dave does all the work, doesn't it, on my Substack?
You recruited well there.
Yeah, no, I've got a terrific team. They're fantastic guys, and he did a nice balance. Well, these are the pros, these are the cons. Basically, the profit dropped 25%. I think the adjusted profit for. Oh, we've got a typo there. It was results for 12/20/24.
Yes.
Successful rollout of a new product. New CEO and CFO joined in May, which is what was it Harvard who put them in?
Yes, I think it was. Yeah, Harvard. Yeah.
But they're not showing as a disclosable shareholder, are they? Or maybe
I understand from a reliable source they own over 2% of it, but not.
Oh, I see. They're just below the right.
Yeah.
Well, that seems to work to treat, doesn't it? Because the shares went ballistic when these new CEO and CFO came in. Obviously, not connected in any way to all the shenanigans that happened.
Yes.
The legal case is expensive. I think there was something like £9 million costs booked. And of course, the legal process has barely started. So you could see that be a substantial drain. We think on balance, given that it's gone up 60 odd percent from the recent lows, we've shifted down. We were green on it for the value, but we've shifted down to amber today because we think the risk and reward are kind of in balance at the moment. Still, there's still a lot of stuff to be resolved there. But also, I mean, what about the longevity of these products, Paul? Because as my guys said to me today, everything that these tags do is simple, generic technology. So surely the competitive threat must be quite significant.
It isn't as simple as you think, because there's a big software and services wrap. It's a bit like using Taser, okay? I.e., such that basically you have to be certificated, you have to go performance testing, you have to get accredited by the relevant governments and the custodials, and you need to make sure you don't get very many false positives when it comes to alerts. And this is one of the best on low levels of false positives. Plus, it's rapid in. Just launched this new alcohol sort of like service that tests people whether they've been drinking as well as whether they should be at home. And it's got this, say, AI layer on top of it as well. I mean, my take, to perfect honest, which into the notes, I was reading about the litigation, and it seems as though they've put a freezing order on the assets of the previous CEO, who's up to potentially £320 million.
I saw that when it said she's given an undertaking not to let her assets drop.
Yeah, I know.
And I thought, well, that's a nice problem to have, isn't it?
I know, yeah. So all the costs and the fines are going to be basically borne by her, probably, almost certainly. And if she disagrees, then they'll just take him off the shares. So because given she owns so much, so I actually think the worst case scenario of any type of fine, ultimately when they sort this out of court, then I'm pretty sure that it'll all be it'll be all a wash, and they'll come out with it, in a neutral position, because they'll reclaim all of their costs. And they did actually hang an olive branch out to the minority shareholders in Buddy Limited, which is the 7.9. The claimants for this, but they've hung out an orange branch just by the word, because I think the CEO said something along the lines, he wants to draw a line underneath. And now in the same sense, they're going to defend it, but they want to draw a line, and it's basically saying, boy, we need to get all around the table and agree this to make it sensible before we go to court in June.
Like you say, these things are usually settled out of court, aren't they? I mean, I have to say, I'm not convinced about the product, because they do have competition, and they of course lost that contract in Colombia, and at very, very high margins, a very profitable business will attract competitors. So I wouldn't completely dismiss the competitive threat. I think that's something that could be an issue, maybe.
Yeah. I'll give you my view, okay? What potentially could happen into the theme of M&A, and I'm drinking my own Kool-Aid with a glasses half full here, okay? I think the CEO and the shareholders will sort this out of court before the end of this year, okay? It'll take a bit of time, but they'll sort it. That will all get through a wash. They'll then start, because I've got a sneaky suspicion the UK custodial contract, which is owned by Serco and G4S. I think it's G4S now. It used to be Serco.
Right.
It comes up for renewal fairly soon. Their solution has got huge political criticism. If you just Google it in the press and stuff, it keeps falling down. It's got problems. Okay, I actually think then they're in the box seat to win that contract. Okay, so if you were G4S, what would you do? You would buy Buddy. Okay,
interesting.
So that would be my take. I just think that this, because that contract is so valuable to G4S in terms of profitability, that they're going to be forced into. Anyway, I don't know at these levels, and I think that's probably what's triggered the glint in Christopher Mills at Harwood's eye.
Well, I think I'll buy back in if it dips down to about 80p then, just so I can. But no, you're right. I mean, it's on the news this morning, actually, about the fact that the UK prisons are full, basically. It takes several years to build new ones, and that so many crimes are linked to alcohol and drug abuse that a tagging solution that means that you're not not overloading the prisons, but where you can act quickly to recall them to prison if they breach the order. I mean, it seems to me to be a very clearly obvious thing that needs to be done, doesn't it? Or do more of it,
Yeah. And they're and Big are really positive in their statement if you read it about the US opportunity, because they've now got they're put onto the preferred supplier list for all of the potential states, and that's an area that hasn't really been sort of optimized over the last few years. In fact, I have heard again from a reliable source that the previous CEO was very, very good, no doubt about it. Yeah. But the last 2 years, she hasn't quite been on the ball, and that was, in terms of looking after the sort of customers and developing. Whether that's true or not, I don't know. But that's what I've heard on the street. That basically. So there's definitely opportunity, but let's all wait and see. One thing the biggest risk I see to big technologies, it does have customer concentration, like Calnex, like Velocity Composites, because I think their biggest two customers, one of them's out in Australia or New Zealand. And I think they're over. If you have the aggregate, the two largest customers, they're over 40% of revenues. So it's a big exposure if they ever lost those. So that's the biggest risk in my view.
Well, I think that's very interesting. Thanks, Paul. That's got me up to speed on it. As I say, I'll put it on my buy the dips list.
Okay, right then. Let's move to one which has had a bit of a difficult time of it this week. Shoe Zone. The market definitely stuck the boot in on it with its shares. Sorry about that. But is this a turnaround, or is this sort of like again something you should give the shoe to, give the boot to? Go on.
I'm not up to speed on it, Paul. So you tell us a bit more about it while I read my notes.
Well, I mean, it's Richard Crow's sort of favourite for a long time. I don't know whether he still owns it. It trades at roughly around about 11.5 times PE because they've reduced their forecasts.
Yeah.
They bought that business, I think, out in the States. Was that in the States as well? No, there wasn't. I don't know if it was actually. But anyway, I mean, obviously, it's a sort of low-cost shoe provider in the UK with stores, and it's. I guess the big question is it being basically, impacted as the likes of Temu and Shein turn their advertising spend into sort of like clothes and shoes and stuff into the UK.
Yeah, I mean, John, my other guy in my team, he wrote a section about this yesterday. Oh God, I don't think I've published it. Oh shoot, I'll have to do that. Yeah, it was H1 results from Shoe Zone, wasn't it? And actually a loss before tax of 2.3 million. And the prior year H1 was a profit of 2.5 million. So that's nearly a 5 million negative swing there just in H1. And they talk about a difficult trading environment. And now the broker forecasts from Zeus anyway were unchanged. But of course, they've now got a mountain to climb to achieve the H2 figures. So I'm supposing people are probably looking at this and thinking, well, an H2 profit warning is very likely now, isn't it? The finances look all right. The balance sheet's okay. It's disappointed quite a few times, though, hasn't it, Shoezone? And apparently the owner managers who own about 50% are brothers, and word on the street is that they've fallen out quite badly, and so there might be operational problems because of that, possibly, but that's only a rumor. I don't know if that's true or not. I mean, you seem to have your ear to the ground, Paul. Have you heard any?
I'm not a massive expert in sort of retail and shoes and stuff, but I think it's a really competitive place. So it isn't something I would go sort of hunting for value. However, having said that, the shares will they remain as cheap as they have been? I don't know. I mean, it's.
I don't know. I mean, you're getting a lot of business for the money, aren't you? And they have recovered in the past. They've disappointed quite badly in the past, and then come steaming back. So it's too early to write them off, I think. So it might be worth people having a look at, maybe.
Yeah. Okay. We've got Syed Hussein is asking about Beeks, which came out with a nice contract win, I think, and that after the close last night, it got the ASX, the Australian stock market, on board. How do you see this one?
Well, it's an old favourite of mine. I think it's very, very good. I mean, I was expecting it to absolutely go off like a rocket today, because this is a really, really good contract win. I haven't got the latest price. It's off my screen, but I think it's given up nearly all of the gains today, hasn't it?
Yeah, it's only up 1%. It's 215. Yeah.
I don't understand it. Very, very odd. So I'm going to hopefully do an interview with the CEO again. I do a podcast with him about once a year. So watch this space. That should be out in probably a couple of weeks or something. I think it's very promising, Beeks. It's becoming the de facto standard now internationally for financial markets, stock exchanges and the like. Each sort of major contract it wins is just another reference site. They've tweaked the revenue model now to a profit share arrangement, which gives them more upside. But I think the way it was communicated a month or two ago seemed to spook the market. But I think now they've actually won a contract on that basis. They've got something to shout about. So I think, I'm very, very, very perplexed as to why there just doesn't seem to be any market interest in them. Maybe it became a crowded trade. It was picked by a lot of people in my Substack annual share competition. We had 7 or 8 people choose it out of 300. So when a stock is that well owned, you do sometimes just find that confidence can just collapse, and it has to just find a base again. But I mean, the news flow from the company has been very good, I think.
Yeah. Good. Okay, let's switch sector. We've got life science. We've got John. He's asking about a stock that I own. It's IXICO, basically. They're the guys who do the brain scan. They do the brain scan analysis for neurodegenerative diseases for a lot of the big biotechs, the likes of Roche and all these other big companies, etc. They came out with half-year results, did met guidance and indicate that they're going to meet guidance for the year ahead. Sorry, for H2 and possibly exceed it as well. It all comes down to future orders. They won a nice little order after the period close, about 500,000. The shares are very cheap, even that they've gone up a bit. They're about 12p now. They're still very cheap at about 1.3 times. It all comes down to winning new contracts, but they are, no doubt about it, the go-to provider for MRI and brain scan analysis for Huntington's disease, and the opportunities now to move into other areas like Alzheimer's, which they've already moved into, and Parkinson's, which they're already getting into as well, and other sort of like CNS type. I don't know whether you had a quick look. It is only quite small, but they seem to be meeting their numbers.
Yeah, I bought some of these back a year or 18 months ago because at the time it had plenty of cash, and I think it's done a recent fundraise, so it's all right for cash. And it's a proper business. It's small, but it had a history of making modest profits, about $1 million a year or something. But then it's had a couple of lean years. My big question on this one, and the reason I didn't look into the results more recently, I think I'm not convinced it can scale up. They keep saying they will, but they never really seem to gain that scalability. So that would be my number one question mark over it. But nice enough little business for sure. But will it scale? That's the question.
Yeah, I think the key when it comes to looking ahead is how many it's phase one sort of like contracts that it currently has. And I think about half its order book is phase one. They're only small sort of like projects, etc. But what you've got effectively a deluge of big pharma spending multi-billions on neurodegenerative diseases, Alzheimer's, dementia, and this sort of stuff. And now the science has been proven, you've got 2 new drugs on the market. It means that the chances of getting phase 1 into phase 2 and phase 2 into phase 3 is now much higher. And it's the phase 3s and the end of the phase 2s that they make a lot of money. The drop-through rate is roughly roundabout on doing one of those trials is roughly about 80%. So that they reckon they can get to 80% on the gross margin. So they reckon they can easily get to a steady state of 65%. Plus, they've got the other opportunities is post-surveillance marketing of side effects for the 2 existing drugs and for things like diagnostics. So there's plenty of shots on goal. And there aren't that many players in this very, very niche market. The key is, though, is sort of like winning those contracts and getting it. If you can get that contract right, then you will be able to. The platform is very scalable, but it's getting multiple contracts. And I think the big pharma now realise that actually this is the last sort of holy grail in medical science. They've got the GLP-1 drugs, they've got the cancer side, and the dementia and stuff, which is such a big killer and affects so many people. Is an area, but it isn't without risk because it is small and it is early stage.
Yeah, interesting. I mean, I personally wouldn't have any way of knowing what the percentage chances of success or failure are, so for that reason, if I were to look at it again, it would just be as a punt, really. But no, I mean, it's a proper little company, so if it does scale up, you'll have a multi-bagger on your hands.
Yeah, good. Okay, let's move to just another industrial one we don't normally look at. Vesuvius, which is very well named because it's an expert in all things molten metal sort of moving. It does sort of like consumables with sort of ceramics, plus it does insulation into sort of steel mills as well to be able to handle molten metal, steel, etc. And
ticker?
Ticker is VS. It's about 900 million market cap company, and it's on trough earnings because of the cycle. Steel obviously production has been impacted out in China and around the world, but again, it's one of the world's leaders in this. And if we do start seeing a cyclical return of steel manufacturing, or just even more in the US through reshoring, then it could be a big beneficiary. I don't know whether you guys ever had a quick look at this one.
Yeah, we've only looked at it once on the 16th of May. That's last week again, isn't it? Yeah. It dropped 2% on a trading update, which we interpreted as a mild profit warning. But the market didn't seem to be bothered by that. It said, I think, full year profits be slightly lower than guidance, neutral tariff impact. 30% of its business is in the US. But I don't know whether it's got US manufacturing facilities or not. Revenue and profit were in line. End markets remain challenging, and it's putting through 45 million of cost savings. Now, the balance sheet is pretty good, but it looks very capital intensive. And there is 329 million of net debt, 1.3 times EBITDA. So yeah, look, I would imagine molten metals. Yeah, that would mean lots of heavy equipment and the like, wouldn't it? Anyway, we conclude. John did a section on this for us. He concluded it was reasonable value. Oh, and he flagged the 6% plus dividend yield. So yeah, we thought this looked all right, quite interesting.
Yeah, I think there's also you've got obviously, long-term trends towards sort of like, all things electrification, so metal and, copper and this sort of stuff. But also I think there's a long-term trend in terms of, steel blast furnaces. They're moving away from coking coal to, is it basically the electricity arcing and sparking one? So you'll need new facilities for the environmental side. So I actually think I know it sounds crazy. It wouldn't be an industrial stock I would naturally think of, but I've got a sneaky suspicion in 5 years' time, this could be a totally different game, actually.
Okay, that's an interesting.
Yeah. I mean, it's only about 8.5 times PE.
Yeah,
which is like really cheap. Pays
and you're getting your 6% yield. So
yeah, exactly.
Quite interesting. Yeah.
Yeah. I mean, you look at Johnson Matthey today. Basically, I mean, they basically sold off what they thought of, or the market thought was a really old catalytic converter business. They sold it for double what the market did, and the shares are up, what, about
a third.
20? Yeah.
Yeah, no, that one was incredible. I couldn't believe my eyes when I looked at my percentage movers list. So yeah, good news on that one.
Yeah, good. I'll just put it up. There you go. Right, okay, let's finish on a good note. I know you own one of them. We've got, this one. We've got Zotefoams. A couple of people are asking about it.
Yeah.
Came out with a trading update or numbers today. Basically, plenty of, looks as though they've got plenty of upside, but how did you read it?
Very positively, actually. I got John to have a look at this because fresh eyes and all that. I normally cover it, so I thought, well, let's get him to on it, see if there's any angles on it I've missed. But he likes it as well. This is, I think, the only share that me, John, and Dave, who are the main team, if you like, on my Substack, all own the same share.
Oh, right. Okay.
Yeah, all three of us have got it. So it was a trading update this morning. Revenue up 8% to a record level. Mixed performance in the different divisions. They're continuing with their investment in a footwear facility in Vietnam, which I think put the markets off because of the tariff impact. But they did quite a detailed explanation of why they're continuing with that today, and it's basically to be close to the customer, which I think is mainly Nike. I think is their main customer. Full year expectations unchanged and it's for quite a substantial increase in earnings because the losses associated with the resource project that's been binned. Unfortunately, the former CEO told us how great it was. They changed the CEO and the new guy binned it within a few weeks of joining. So that was a great pity. And the shares have never really recovered, but they're up about 20p today, I think, aren't they?
8%, yeah.
Yeah, 8%. So no, we're pleased about that. They said the tariffs were a manageable headwind. Balance sheet's fine. It's quite capital intensive, but it's got net debt is modest at 0.9 times EBITDA, and they own the freeholds to their factories in Croydon and America. And again, they can supply to America from an American factory. So, and it's on a PE of 9.
Yeah.
I mean, to us, it just seems the wrong price. Surely, because they've got real, global specialism. We think surely it should be on a PE of 14 or 15 in a normal market. So we don't understand the valuation of this, why it's so cheap. So I'm hoping to buy more. So hopefully it'll go back down again.
I did read, I think, in the commentary somewhere, that the adoption or the penetration rate of high performance foams in sneakers like your Air Jordans, you said, is still less than 10%. And
it's very low, isn't it? Yeah.
Because if you think about it, if it gets to 50-50, which frankly could easily happen, things like everybody moving towards electric toothbrush, becomes the de facto standard, then that's got to be a home run for these guys.
Yeah, well, people should have a look at the last webinar that management did, and they're super bullish. I mean, they sound sensible people, and it's a proper, profitable, cash-generative business. Really, the CEO there sounded really, really fired up about all the growth potential that they got in all these. He said basically they're right. I think they're kind of trying to find specialisms and then going deep into certain product areas. It sounds like a good strategy. So, and I think a fresh face with fresh ideas coming in, maybe that's what it needed. So yeah, we really like Zotefoams. We think it's very good.
Yeah, good. Okay, actually, we've just got one final one from Rising Bull 1985. He's asking about one you own, I think, which is 4 Imprint, which is basically the marketing promotions business. Came out with some good results last week, or a trading update. Quick words.
Yeah, it was fine. The update was reassuring. People, again, I think, assumed that with it being a US-focused business and with tariffs maybe for the underlying products that it then gets specially adapted, would all be terrible. So the share price is almost halved from the highs a few months ago, and the perfectly benign trading update came out on when was it? 21st. That was yesterday, saying revenue in line with last year, order intake slightly down 2%. Well, that's nothing, is it? Given that we got tough macro, gross margin strong. It said there will be some potential impact from tariffs, but they can manage it. Lovely balance sheet with plenty of net cash. It's just paid a whacking great dividend as well. I bought some of these. Yeah, I couldn't believe it. I only bought a little position in my spread bet account. Suddenly I got this colossal dividend in.
Fantastic.
It was about 10% because they paid a special and a normal fee. So I think it's great. I love this one. I want to buy more.
Brilliant. Okay, great. Well, thanks very much, everyone, for your questions. Brilliant insights from Paul again. Next week, just to prepare everyone, we're doing it at 2 o'clock on Wednesday. I'm going swimming in the sea next week. I'm going on holiday down in Devon, so from Thursday onwards. So it's nice. Me and Paul will be 2 o'clock on Wednesday, same channel, same place, and same format. So if you want to ask questions, then please pack our brains and join us for the 2 o'clock show.
Well, I'll be in Alderney next week, so not that far away from Devon. So you see,
what are you doing there?
Just working remotely for a week and enjoying nature and the history and everything. And so it's
the Channel Islands, isn't it? Alderney's the Channel Islands. Where, the Nazis basically they basically occupied it, didn't they?
Yeah, fascinating. They did, all the Channel Islands. So it's a fascinating area because I love history and nature. So, but just to change the scene, it's one of my not holidays. Where you just carry on working as normal, but somewhere different.
Brilliant. Okay, we'll look forward to touching base from Alderney next Wednesday at 2 o'clock. Thanks, guys.
Nice. Yeah, cheers, Paul. Thanks, everyone.